Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Well, we got that top we were looking for yesterday, so we're starting to see the markets roll over. And what might be the next catalyst for a bigger down move is going to be with the banks. And we're going to show you some really dangerous data here. So you're not going to want to miss this video. Let's dive in.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Hey, Bob, again, we see charts. We're going to cover one here in a second where the divergences from reality are just mind boggling.
Yeah, Phil, I think the word you were searching for in your opening was bizarre.
Yep.
Because I don't know what they're doing with the data, but we're definitely not getting the proper discovery, because reality is telling us something different than what the banks and the government wants us to kind of believe. And this first chart you're going to show here, this is amazing to me. I can't believe that credit spreads are not reflecting a blowout here. I think this is all part of this bizarre belief that they're going to outpace the Fed on this.
Yeah.
I think everybody's praying. You ever I don't know if you guys ever landed in the San Diego airport, where you just come straight down, and on the other side of the airport runway is another hill, and so when you land at that airport, you're like, man, I hope they stop in time. And I think a lot of people are like hoping and praying that the Fed stops in time to basically save their asset values, and so everybody's just kind of on some sort of bizarre pause, and they absolutely do not believe this man. They absolutely are convinced that he's going to have to bring these rates right back down again, because that's what's been driven into people's Pavlovian mindset here for the last, I guess now, 40 years. And so this thing with bankruptcy filings are ahead of credit spreads. I mean, you would think it would be the other way around, no?
You would actually, yeah, or at least somewhat in tandem. But if anything, in the past, it's been the other way around. You're right.
Yeah, so, and it's not just that. Throw up this next chart here. This is also really fascinating too.
Yeah, this next chart is basically provision for loan losses. So you're going to have this, ideally you want this number to be negative, so the histogram bars are going down below the zero line and not up. And this is not something, when you have these provisions for loan losses, this is really not something that you see if we're really truly in a bull market. And the last time we had levels up here was Q4 2022, and then, as you guys recall, Q1 we saw bank troubles. And so I think this is a little warning indicator here that the banks are bracing for more impacts. And we got things like the commercial real estate portfolios are still in huge trouble here. I don't think we've really seen we're just at the tip of the iceberg, I think, with commercial real estate, and that is the huge elephant in the room here. But yeah, growing loan loss provisions in banks is not something you want to see.
No, and the thing is, what people don't realize, most banks are publicly traded that really matter, and they're loath to show this because they know that's going to affect their stock price. So they do everything they can. They change. Phil, I don't know if you remember this, they changed the accounting rules that they didn't have to mark losses unless somebody's just literally stopped paying. Remember that?
Yes.
So they don't show any impaired assets. They don't show any loan loss provisions. They'll be at your door, knocking on your door. And look, if you can't make a mortgage payment or a bill payment, you better be not making it when nobody else is making it, okay? Because then they're going to do everything in their power to not allow this number to go up and not allow the asset values that they have on their books to go down. But this is still creeping up. They do everything they can to keep this thing from going up. It still goes up. And this next one, this is bizarre. I'll let you take this one because you made a really interesting comment to me when we were doing our pre-podcast discussion. If we only knew. Remember that conversation?
Yeah. So we're in an age where we have this reverse repo window, right? That wasn't always there. Okay, that was something that came about more recently when from the great financial crisis. They needed more tools to deal with the banks and help the banks out, essentially giving them a lifeline. What was interesting was in 2019, all of a sudden, the market's grinding higher and just normal market stuff, and a little less volatile than what we have today, but grinding higher. GDP was doing good. Overall, things were looking okay. And then all of a sudden, out of the blue, this is a Q4 of 2019, and the reverse repo window opens out of the blue. And we remember we were talking about it when we had read the headlines the next day. We're like, that's kind of weird. Like, why, usually you don't see that unless there's distress. And we didn't really see anything. But when I was looking at this chart, you noticed that when we got into that time period right before COVID, we noticed that the loss provisions spiked way up, right? If you notice that blue line just has a sharp turn higher. Meanwhile, bank earnings went under. So you had this cross up of the loan loss provisions. And I think, you got to keep an eye on when these two lines converge, and they're starting to grind closer here. Something to keep an eye on, because if we do cross up again, I think that's going to be because we're dealing with a lot of bank instability, or maybe these the commercial real estate portfolios start to really take its toll on the banks. I think at some point we're going to get a credit event. We're going to get it with the banks, and the Fed is going to be once again forced to open up more of these windows. Right? You still have the window from March that's open, and they're still tapping it. It's just not growing like exponentially like it was there for a little bit. But we're probably going to run into another situation, and it's going to be weird because all of those actions, because of the way things are flowing right now, adds liquidity to the markets. And that's adding to this dislocation, right? Where reality, things are like really bad, but because of the leverage and the liquidity flows, you actually see like the opposite effect sometimes in the market. At some point, we're going to get a big enough event where it doesn't matter what the Fed window's doing, things are going to start triggering, and you're back like in 2020, overnight you're getting limit down, meaning that you're hitting the maximum down moves overnight, which is like, we're talking like 7% in S&P 500, and it triggers basically circuit breakers until the market opens the next day. That happens all through March of 2020, if you guys recall. So, and that's, again, that's because the banks were locking up. So that's my biggest fear right now, is that we're in a situation where this situation of banks locking up is brewing under the hood, and it's not getting better, as you can see with the growing provisions for loan losses.
Yeah, it's going to be a baseball bat to the head.
One thing, Bob, let me real quick. I want to flip to, before we dive into the charts, I wanted to flip back to this just to point something out here on this chart with the credit spreads. If you notice, we're on the bankruptcies, I should say, we're nearing that 12.5% level. That is recessionary prints right there. We're far above the dot-com bust area, right? Because that only got up to about 10 on as far as bankruptcies. So it's very abnormal what we're seeing here, and to have the markets at the levels that they're at. So I just want to point that out, that this is another data point telling us that basically we're meeting all the criteria for a recession. It wouldn't be surprising if we're actually already entering one. So anyway, yeah. So your chart here on SCMI.
Yeah. So last week we were telling you guys, if you noticed the title, we said the AI sell signal came in, and tops are a bit of a process. So we're looking for the a little bit of confirmation from that. And this is SMCI, which is basically Super Microcomputer. They're a retailer, but they sell a lot of cloud computing blades, and they have AI chips in there, and basically they're riding the coattails of the NVIDIA and the AI move. Well, we went ahead, and when we ever see a combo sale, if you guys want the signal, it's called the Trader Toolkit signal indicator package. You can get it tradelikeagenius.com. Encourage you to do so. And last time we did it, we had a nice move down on SMCI. So basically went from 250 area, I wrote it all the way down. I think we got as low as 212 before we got a a buy signal. If you see the buy signal, if you look on the bottom where the little red bar, vertical bar is. But I want to point your attention to the big red arrows to the right. We got a Kona cell and a sniper cell together, and two signals are awesome. But we got a third signal. We got a heat signal as well. And so that's the trifecta. And you got to pay attention to that and buy puts when that happens, because, you know, the last time we had this move, we dropped 12%. And this move probably be bigger because Apple actually is a big customer of SMCI, and Apple basically is getting into the chip game themselves. They're not going to buy these blades from SMCI probably in another year or two. And people, when they gave the people this valuation for SMCI, this thing was probably Apple's going to be a customer for 10 years kind of valuation. It's insane. So I fully expect an Eiffel Tower here, Phil. And I went ahead and I already have some shorts on SMCI. I extended them out in time so I could sit back and relax. And that middle one is not part of the package. That's just, for me, I just like to see a momentum. So I just point out that momentum also fails, which is obvious because momentum just follows price. So I wanted to show people that because we talked about that. This really dovetails to what we talked about earlier. So we saw so many of these signals on Tuesday and Wednesday, Phil, that we knew that today this market was going to soften. Mm-hmm. And then with your signal that you're going to talk about now, why don't you show that one as well? This gave us total confidence that we're going to at least get a tradable sell-off.
Yeah, so this is our 12-hour chart with the ES or S&P 500 E-mini futures, and this is actually a 12-hour time frame because I like the way that our heat indicator signals. Again, this is part of the Trader's Toolkit that you can get. And I can give you this template, but below you'll see our heat indicator, which is an oscillator type of indicator, and it paints these gray bars when the cycle's topping and rolling over, and you know you're already in an overbought condition with the shading there, that hot pink shading at the tops. But you'll notice I put a red line, vertical line where that signal occurred, and you can see it's very bearish for the markets and usually results in an extended down move. And so last night we had a bar print as we went into the close yesterday. So confirmed overnight because these are 12-hour bars. And so now we've got a confirmed sell on that as well. So we're looking for more downside weakness, as we said. And I'm expecting, actually, now that we're breaking this very steep trend line here, I'm expecting a rotation that should take us down to that lower trend line, which would be, you know, depending on where we intersect with it, but should be somewhere around the 4,500 area. So that would be a pretty conservative move for this signal. And some of the other ones that have fired were actually major market tops too. So kind of depends where you are in the cycle and what's going on with flows and things like that with liquidity. But in the short term, you should see a pretty substantial move down. So these are great signals. You can set alerts for them for the 12-hour time frame when they fire off. Then you know you can get into credit spreads or buy puts or just get short of the E-minis or micro futures as well. Or if you're managing stocks, you know the stocks are probably going to be rolling over from that signal as well. So really valuable signal that this in and of itself, if all you did was take 12-hour signals, with great warning for hedging yourself.
Yeah, this thing's amazing, Phil. And especially if it's interesting. Phil and I, we actually trade very differently from each other. I'm really active in the markets, day in, day out. Part of it's because of the service. I'm always looking for trades, and then I can't help myself. I take them too. And but Phil likes to look for the nice fat pitch over the plate, and he likes to grind these things. The last time we got these moves, Phil, what were you had 80 some points on Futes on that. I don't want to put words in your mouth, but you had two big runs in a row, and I think we're setting up for another potential 80 to 100 point move on ES. We're probably already a third of the way into it already, but that's what kind of moves you make. And interesting about it is that if you want to be a trader that's not tied to your desk, you take these kind of big setups, and you could be in these trades for 1 to 2 weeks, and small amount of money can basically pay your monthly nut. So that's why Phil loves these things, and for me, it just gives me confidence to really push a little bit harder on some of the directional trades I'm saying. Like yesterday, I said, hey, look, I closed all speculative longs. These signals are screaming at us, and so I don't want to fight the tide. And so we're well positioned for today, and those are the kind of things that we can help you with if you want to trade with us.
Yep, agreed. Head over to tradegenius.co, guys, and you can pick up the Trader Toolkit or any of the other offerings, our newsletter as well. And I think you'll find those things really helpful in managing and taking trades intraday during the week, or even swing trading longer time frames. It's applicable to all that stuff. So head over to tradegenius.co to check that out. All right, well, that's going to do it for this video. Thanks a lot for watching, guys. Stay tuned. We're going to have more for you tomorrow. Please hit that like and subscribe button and smash that notification bell and set it to all if you can. That really helps us out. We'll see you on tomorrow's video. Take care.
Trade